Hello, welcome to Money and Investments with Babajide Komalafe. In case you are joining or watching this program for the first time, Money and Investment is all about how to make more money even from the money you have now. And this is the eighth episode. So you can search for Money and Investments on our Facebook live page to get the previous editions and watch. Now, remember, in the last three episodes, we started a discussion about investment in the stock market. And I said that the purpose of this series, particular series on the stock market, is to demystify investment in the stock market. It's also to enlighten, particularly the younger ones who may be interested in investing in the stock market. And I said that even though you may know about investment in the stock market, you will do well to share this presentation with younger ones around you so that they can learn from it. So, in the previous edition, we defined what a share is, and we said a share is a unit of ownership of a company. Then we have discussed how to buy new shares of companies. And then thereafter, in the last episode, we discussed how to buy existing shares of companies. Now, today, I'm going to be talking today and about four other episodes thereafter. I want to talk about the principles of profitable investment in the stock market. Now, some people just don't want to hear the stock market again. There is apathy to anything stock market in the minds of many people. Now, this apathy is understandable and it is based on the experience that many people have during what happened in the stock market in 2008, 2009, stroke 2010. In 2008, there was a global financial crisis that affected the stock market. The market actually crashed and people lost money, a lot of money. And because of that bitter experience, a lot of Nigerians don't want to hear anything about stock markets. But the truth is that investment in shares, buying shares, investing in shares, investment in the stock market is still profitable. It's just a matter of understanding the principles to follow to be able to make money from the stock market. So, what is the first principle? The first principle is that you should invest for the long term. Invest for the long term. In the short term, all businesses experience up and down in the short term. And these, challenges most of the time is due to unforeseen circumstances. Unforeseen circumstances. For example, we had COVID, and during COVID time, a lot of people had to stay indoors. A lot of businesses were negatively affected. So, in the short term, most businesses have challenges that affect their revenue. Their revenue will go down, their profit will go down, and as a result, the share price of this company also, will go down. Now, but in the long term, every well managed business, and underline the word well managed businesses, well managed companies, they prosper and they are profitable in the long term. And in the long term, over a long period, their profit will go up, their value will go up, and their share price will go up. So let me give you the example of Nestle PLC. In 2007, the share price of Nestle was 20 naira 81 kobo. 20 naira 81 kobo. In 2008 February, when the stock market crashed, the share price of Nestle fell to 9 naira 9 kobo. So you can see from 20 naira in 2007, the share price of Nestle fell to 9 naira 9 kobo. But presently, as we are talking today, the share price of Nestle has risen to 1,100 naira. So you can see that during the crisis of 2008, all companies were affected. The share price of all the companies went down. But over the long period of time, the share price of good companies, they go up. So, and that is the reason why it is very risky for you to invest in the stock market for the short term. If you go to buy a share for, say, in the next 3 months, 6 months, I will sell it, I will make money, you are taking a huge risk. Why is it so? Is because you may be buying the share of the shares when the price of the share is going up. And when you will need that money and sell that shares, maybe when the price is going down. And that is what happened to most people that lost money in 2008, 2009 stock market crash. They bought the shares when the prices of these shares were going up. As a matter of fact, from 2004 up to 2007 December, price of shares of almost all the companies were just jumping. A lot of people joined and bought when these prices were going up. And then when the market collapsed, many of them needed their money to pay school fees to do that. And now the price have gone down by almost 80 to 90%. And that's why if you want to make money investing in shares, investing in the stock market, you must make sure that you invest for the long time. Thank you. Make sure that you share and also watch out for the next episode. Bye bye.